Hey everyone, welcome. Good to see you. Hope you guys had a great afternoon or great day. I know it's probably a little hard and difficult for some people at least, but hopefully you navigated that well and hopefully some of the levels that I gave you guys helped you do so. So let's see, we've got Kay, Dan, great to see you guys. Took a large loss on overnight options. Oh, well, that's unfortunate. Hopefully you were allocated appropriately, so it didn't hurt your portfolio too badly. This is what often you'll hear me talk about how when you change volatility regimes, you've got to change your strategies and you've got to change your risk management activity in order to match that volatility regime. That's why it's the very first thing I look at in the post-market. So we'll take a look at the volatility regime. We'll talk about certain things that we may or may not want to do during this shift in the volatility regime. We did get a shift in the volatility regime. We don't know how long that will last. It might just last a couple of days. But as long as we've shifted, then we want to modify our trading based on that. Better today than yesterday. Okay, that's good, Kay. All right. Hi, Lise. Great to see you. Phil, great to see you too. So let's take a look at real fast at the Telegram channel. Again, there's people who are posing as me, using my likeness, my voice, videos that appear to be me and they're not me. So just be very, very careful. I'm never going to ask you guys for money. The only thing I do is this stuff and potentially pitch you one of my programs. That's it. So let's take a look over here and see what we had early in the morning before the market even opened, or actually, sorry, maybe within 1 or 2 minutes after the market, 3 minutes after the market opened. I showed you guys these SPX and SPY gamma levels. It's really unusual to be completely orange like this. And over here in the SPY, you could see that there's just a tiny, tiny blue. Basically, all exposure was negative. So that obviously was bearish. We opened it near 625. Let me just verify, make sure I'm not putting my foot in my mouth. We opened at 626.3. So as always, large gamma exposure is areas of a large reaction. I felt that since we were opening at 625, that we could potentially see 625 as support. But I also noted that if we break that, then it could get pretty ugly. And we broke it. It didn't even, the 625 didn't put much support at all. We basically just broke it and went down. We saw tons of these levels in net gamma for exposure, but basically we just slipped right down beyond all of those. And then later on, we talked about how, hey, everything is still there. And even though the S&P had dropped below, we did find support at 620. Let's take a look over here. We found some support early on at 620. And then basically we chopped sideways after that. And I talked about, let's see what time I threw that up. That was about 11:44 Eastern time. So 11:44 puts us right here. Okay. Maybe a little after that. And I said, is that right? No, it needs to be 8:44. This is on my time. Okay. I was like, that's a little late. So yeah, we did it right here. And I said, that is probably going to define our range for the rest of the day because it's a Friday. We are going into the lunch hour on the East Coast. And basically not a lot of stuff gets done except for the last hour positioning and preparing portfolios for the weekend. So from there, we did basically just chop between 620 and 625. We got this choppy sideways movement. So hopefully that gave you guys a clue, maybe gave you a chance to make up some of the money that you might have lost on an overnight drop. Personally, I took a exit SP trade. Basically, SPY. So if we look at the equivalent on XSP, you can see that right here, that's actually the spread that I did. I did a 621, 622 spread, and at the time we were below 622. I felt that this would be a bottom and that we would go upwards based on everything that I talked about over here. I didn't have a lot of time to throw that out, so I didn't give it as a bonus trade to anyone. Plus, elevated risk, I didn't want to explain to everyone how carefully they have to manage their risk. But that one actually made a nice return there, 215% right there. So the gamma levels can be very helpful if you use them correctly. They're not the key or the answer to everything. You still need your skill and your discretion as a trader. You still need to properly manage all of your risk. But if you have the right tools and you have the right mindset, because I could have easily have lost. Like if I was wrong about this and went down, then I could have lost, but I didn't. So you just need to manage that risk appropriately. When we have this higher volatility, which we are now experiencing from the very open of this morning, our open was right around 6:30, so we're already at, call it 19 to 19 and a half when the actual trading session opened. And then we shot up to 22, we ended at 20.42. That is a new volatility regime. We were 15 to 20 before, now we're at 20 to 25. So we are going to want to know how long we stay in here. Oops, that's not, okay. So depending on how long we stay in here, it's going to dictate our trading. Are we doing this or are we doing this? If it's just a couple of days, then all we do is we sit out on it for a couple of days. But if we end up doing this, then we need to drastically modify how we're trading. So one thing is our allocation sizes. So a lot of people get greedy in times like this, and in instances like this, or they don't even realize necessarily that they are getting greedy, and they think they're just doing par for the course, right? Everything is normal, but everything is not normal. You've shifted into a volatility regime, so something that was not greedy behavior before becomes suddenly greedy now. I'm live. So if I'm in a shifting volatility regime, I need to examine my behavior very carefully. So normally if I might allocate $1,000 and my average trade return is 50%, then that means I am going to expect on average a $500 return on my money. If we shift into a different volatility regime, basically that volatility shoots up. So prices of options go higher, prices tend to move directionally, or at least in a larger range of directions. And so you could easily on the same trade, especially if you put on that trade before the volatility moved, then that same trade could return 80 to 100%. So let's just make the math easy and say the same trade that you would have put on before would make 100% because of that increasing volatility. And then you make 1,000. And you say, that's great. I love that. My trades now, I have opportunity to make more money now. The problem is if you do that, you're not taking into account the extra risk. The reason why your trade returns more is because you're risking more, that there's more risk in the market. So you're getting compensated by the market for that additional risk. But if you don't understand that you have additional risk, then what you've done is you've allocated, you're putting your dollars at more risk than you thought you were. So the appropriate thing to do would be not this. You'd say, hey, normally on my trades I make $500. You know what? I still want to make my same $500. So I would move down my allocation to half of what it used to be, make my 100% on the same types of trades, and then that would be the same $500. So so this is what I mean by not being quote unquote greedy. I'm not chasing after the $1,000 gain. I'm trying to make the same amount of money that I normally do, but I get to do it with less capital at risk now. So that's how I think about shifting my risk parameters and my risk allocation during that regime change, this particular change where we're going higher in volatility. And this is just considered medium volatility. It's not even really high volatility. If we went to really high volatility, then we would have to shift again. So we've got to keep that into account, and we have to understand that volatility means that we're going to swing some more, and we want to switch strategies. One thing that I said was if we make our same normal trade, then we can make potentially more money on that trade, but we don't want to make that same normal trade. So what I said applies to trades that you initiated before the volatility regime. And now that we're in a different volatility regime, you want to take different types of trades than you were taking in the previous. So if you're going to start a new trade, it's got to be appropriate for the current volatility regime. Now that can be a little bit tricky right now because we don't know how long VIX is going to stay above the 20. It could just be a couple day event like over here, or it could last a little while. So what does that mean? If you're going to initiate a trade, then you would either do it a little bit later when you know that this is more than just a 3-day event, or you've got to take in types of trades that would be okay either way. And what that means is volatility is higher and stays high, or volatility is high and collapses down. Okay? And that is not a basic call or basic put. If you buy a basic call or basic put when volatility is high and then it collapses down, good luck, buddy. That's like taking a trade right before earnings on a basic call, basic put. If you don't get that huge price movement, that volatility collapse is going to kill your trade. Even if price moves nowhere or moves in your favor, that volatility collapse could still send you into a loss. So we will have to understand that if you initiated a trade today, or you initiated a trade on Monday or Tuesday, maybe even Wednesday, there's the possibility of this collapse happening right from underneath your trade. So this is not the time to initiate the executions that we have, and it's not the time to initiate the normal trading strategies or the trade ideas that we have. So what does well in this type of regime? You want to consider instead of trend following, oops, that's not, wrong window. Okay, instead of trend following, so we're still in an uptrend right here, we want mean reversion type of trades. That would be more appropriate, because what we're saying is there's a lot of volatility up and down, but if the price moves extreme, that volatility is going to swing it right back in the opposite direction. So I'm no longer trend chasing. I am now going to look for mean reversion trades. So anything that leaves the mean significantly, I'm going to expect it to swing in the other direction. And I know that sounds odd to some of you because you hear certain people say trend, 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 just trend, trend, trend all the time. And if you that is true in the appropriate regime, and that's not right now. Okay, so maybe we'll go back to it in a couple of days, but not right now. So what we're looking for here is mean reversion type of trades. We want to be things that benefit from collapsing volatility, but don't completely rely on it, because We don't know if, again, if VIX is going to be here just for a couple days or for an extended period of time. So if it's a couple of days, then we'll get that volatility collapse and your trade will benefit. But what if it extends for a little while? So you don't want to be completely reliant on a volatility collapse. You want a trade that still does okay, even though volatility stays elevated. So what that means is I don't want to just sell a call or sell a put, because selling a call or sell a put would benefit from a collapse in volatility. I will be able to sell it at a higher premium than I might normally. But what if things just chop sideways? I'm still stuck. It's better than buying a call or buying a put for sure. But ideally, I would have something that could benefit from something other than a volatility collapse. But if it does collapse, that's just an added bonus. So that sounds a lot like a vertical to me. And it doesn't matter if it's a credit or a debit, because I've stated, maybe not on this post-market analysis, but mathematically it is proven that they are the equivalent. Their behaviors, their sensitivities to vega, to delta, to gamma, to all of the Greeks, they're the exact same. The only difference that you might get is the volatility skew. And I'm sorry, volatility skew. You might get put call skew, I should say, not volatility skew. You might get put call skew, and that will change the performance, but only a little bit. And by the time you hit expiration, they're the same again. And so then it's just the only difference then is a mismatch in the pricing, which is a different type of skew. So the market maker, if you did a credit spread, maybe you could make 15% on your risk. And if you did a debit spread, maybe you could make 14% on your risk. Similar levels, but one is performing a little bit better. So you can get skew that way. That would be the only time there would be any difference between that credit and debit spread. So just understand that, because basically everyone says that wrong and gets it wrong and explains it wrong. Okay, so just understand that mathematically the credit and debit spread are the exact same, assuming you can get the same price. Okay, so what you want to start looking for is those types of vertical spreads. Those are going to perform a lot better for you. And I got a great question right before we had this the call, and we had a question from my email on whether how volatility affects things. So I apologize. Ignore the background. That's my dad. It's his birthday today, so he's hanging out for a little bit. So let's take a look at how volatility affects a existing vertical spread, and then how volatility will affect us going into a new spread now that we're already in the regime. All right, so let's see. We've got thanks for the guidance for the 620 to 625 as part. You're welcome, Carla. And hi, Kirk. Hi, Elena, Green Farmer, and hi, Raj. Can I please repeat which part of it, Raj? I'm sorry, I just saw your comment, so I don't know if you just asked that or if you asked it several minutes ago. So if you're more specific about what you want me to repeat, I'll be happy to. So if we take a look at a vertical, so let's take a look at option strat. So let's just say you already have a vertical in place. This is going to be a little bit harder for me to demonstrate, but it'll be all right, okay? Because this is assuming, obviously this is after that volatility already started to spike up. But just say we have this existing spread. Okay. And just say we're a little bit into it. All right, we didn't do this today. We did it a few days ago. So let's go out to, say, Monday on this. So how does volatility affect your spread? Let me do something that I'll show something more extreme, just so you can see a little bit better. Okay. I need a longer maturity. That would show it better. Okay. So right here, how volatility affects your spread depends completely on where your price is, the underlying price is, relative to your maximum gain and your maximum loss areas. Okay. So, and this is actually true during all times. It's not just during times of high volatility. This is also something that people don't understand. This is going to be true. What I'm saying is going to be very similar about time value as well. If I am really far in to my max gain zone or my max loss zone, volatility isn't going to do anything. Okay, so if we see that way out here where basically it's already priced at the max gain or max loss, when I move around volatility, nothing happens. Okay, you can see, like, just look at this point right here. Okay, does this curve go up or down when I'm moving this around? The answer is no. You're already so deep into the max loss or the max gain that it doesn't matter how much prices swing up and down, it's super unlikely that you're ever going to get down to your break-even points. And so therefore, your trade just doesn't care. The spread just doesn't care about that volatility. Okay. So let's just say though, you're not so far out. Let me give this, there we go. Let's do this. Okay. So we're not so far out. So if I'm in my max gain zone, that volatility, if it increases, what it means is that there's a higher chance that we could get shunted out into my loss zone. Because if volatility is just doing this, back and forth 50 cents, the probability of us moving all the way out into the loss zone is very, very low. So low volatility is good because I'm already into the max gain zone. Same thing over here. Low volatility means I'm very likely to get back into profit. So that volatility is not going to move this much. So if I do this, okay, you can see that it is over here, that's profit, right? That's profit. So if I go here, that profit starts to move downwards. It curves down. So let's find, for example, at 650, where I have this no change in volatility at 650, I was looking at 37% profit. And if I move out to 2 times the volatility at that 650, I'm only looking at 32%. So I lost 5% because of that increase in volatility. Okay. And then over here over here, it actually works in my favor. Logically, it shouldn't, but just because of the curve, so if I go 570, I'm losing 95%. But then if I double it, then at 570, I'm only losing 61%. Okay. So basically what we're saying is that massive increase in volatility makes it more likely that I can move out into the gain zone. And the massive volatility, if I was already in profit, makes it more likely that I can move it into a loss zone. So that's why it is favorable to me if I'm in my loss zone and disfavorable to me if I'm already in my gain zone. Okay, so that's why I opened this with saying it depends where you are relative to your max gain and max loss zones. All right, so hopefully that made sense. And the same is true, just so you guys, just to finish off your education about vertical spreads, is about time. Okay, so if I'm in my gain zone, then passage of time is favorable to me because now there's less time for me to move out of the zone. And so my value should increase and increase and increase. And then same thing over here. If I'm in my loss zone and time goes by, then I should lose more money because there's less time for me to get back into the value zone. So a lot of people will tell you that, for example, and what did I say about debit spreads and credit spreads? I told you they were mathematically the exact same. So this is going to behave the exact same way on the equivalent debit spread, okay? So let's do the equivalent debit spread. It was a SPY August 29th, 619, 620. Okay, see that? So if we go out to maturity, this is the same spread. Oops, what did I just do? There we go. 619, 620. Okay. So what I said was that as long as they were priced the same, then they would be the same. So this is a $32 net credit, and meaning what is that, $68 max loss. So as long as I pay $68 on this other one, right? So we're $1 apart. You see how there's just a very, very, very tiny mismatch price. So if I correct that and say we get the exact same price, where do I buy it for a little bit less? Okay. We've got these halves to deal with, these hidden halves. Oops, I need to sell for a lower price. Okay, so I have a $68 max loss at $32 max profit. I have a $68 max loss at $32 max profit. These are the exact same equivalent, except one I'm doing a bull put spread and the other I'm doing a bull call spread. What is my max profit, max loss? Just told you, they're the exact same. What is my break-even point? 619.68, 619.68. These are the exact same curves. Okay, so a lot of people will tell you, I'm going to do a credit spread because I'm going to collect that money. I'm going to sell the time decay. That's going to put the time decay in my favor because I'm selling and because IV is high, or whatever other excuse they want to make for going into a credit spread. But guess what? Depends where you are relative to your max gain zone and max loss zone, just like the other one. Why? Because they're mathematically equivalent. So if I'm in my max loss zone, the passage of time is not my friend because I'm going to lose more. So at 614, watch this, 47%, I lose it. The passage of time is not in my favor because it's going to collapse towards 100%. Because we have less and less time to get into that profit zone. So it is a complete misconception and complete lie that you are selling time, you're selling time decay just because you're doing a credit spread, okay? Or sorry, I showed you on the wrong one. Let's do it over here. So in the credit spread, okay? So it's complete lie that, hey, I'm selling credit and I'm selling time. And so the passage of time is in my favor. No, it's not if you're in the loss zone. It's only in your favor if you're in the gain zone. But guess what? That's the exact same thing is true in the debit spread. So you're saying, oh, well, you're buying and therefore time value is against you, and IV is, that you're not going to get paid because you're buying that implied volatility and the market maker is making that money off of you. No, wrong. The things that are true about your single call and single put are not translatable over to your vertical call. These two are there, or vertical spread, whether it's a call or a put. Okay, so mathematically, it makes zero difference because guess what? I'm both selling and buying a call. I'm both selling and buying a put, and they're the same strikes and same expiration, and so they're going to be this equivalent of each other, opposite. Okay, but that's what we're doing over here also. So that's why they end up being the exact same. Okay, so don't believe the myths, don't believe the lies or misunderstandings. They are the exact same, and volatility is volatility. Doesn't matter if you're a credit spread or debit spread. That volatility, increasing volatility, hurts you if you're in the profit zone, and it helps you if you're in the loss zone. Why? Because increased volatility means that there's a more likelihood that you could flip into the other zone. Okay, and same thing with time. The increase in time makes it less likely that you can flip into the other side. So either that's favorable for you or not favorable for you. That's it. So everything is just relative to where you are inside of that time zone. Okay, it doesn't matter if we started out in a high volatility regime, or we started in a low volatility regime and then went into a higher volatility regime. Okay, so basically what happens is if I put on this trade today, no passage of time, okay, and then I'm at this particular implied volatility, and then volatility suddenly goes up, okay, what it means is that it makes it a little bit, I've got to wait a little bit longer, right? So that price, I become less sensitive to price. You see how I flattened out, but it floated upwards, but everything flattened out. So we become less price sensitive, which makes sense, right? If prices are going to move all over the place, then we wouldn't want the price of our spread to suddenly move all over the place as well. It becomes a little bit less sensitive to that price movement, but it becomes sensitive to the implied volatility movement. All right. So that's how volatility affects your spread. So basically, if that implied volatility didn't move and you're at 630 on this particular spread, you would have been at 14%. But because volatility went up, so that 640, what did we say? 30, 40? I forget. I think 30. Okay, so now you're at 22%, right? Instead of that 14. And then the other way around, okay, if I was at 610, then I was at a 24% loss, and then we flip up here, okay, 610, suddenly I'm at 3%. It helped me out because the possibility of me swinging back into profit was higher. Okay. Any questions about that? Does that make sense? Debit credit spread. Hopefully I explained enough that you don't need me to repeat it, Raj. So I guess you're answering my original question, what did you want me to repeat? But then I went deeper into debit and credit spreads. So hopefully there's no confusion there. Happy birthday to my dad. Thank you, Robert. Thank you. I'll let him know. How do I make entry and exit decisions based on volatility? That's good. So if it's a single and I was in that single before the volatility changed, what it means is that, let's just say, let me find a good example. Hood. Is that a good example? Okay, let's say I went into Hood yesterday. And I said, we're in a certain volatility regime. So I'm going to put a nice little stop right here. And I'm going to set my target somewhere, I don't know, like this. Okay. And so I'm going to set my target up here. Let me do it long position, okay? So if I entered here and I said, okay, I get to set my stop over here and I want my target up here. And that's a 2-to-1 reward risk ratio. And today we get a whole bunch of volatility and we move down below my stop. By my own rules, I should have stopped out, but in a volatility change, I don't know if this is directional yet. And maybe it is, okay? Maybe hood was a bad example, but this could swing right back. This could swing right back, and look at how large that range was. If I took this same candle and I put it up here, then tomorrow it could potentially hit my gain. So if I stop right here, then I'm going to look like an idiot because it would have hit my target the very next day. So because I know that there's going to be a larger price fluctuation, what it means is that I've got to give my trades more room to breathe. I can no longer use this same stop. And in most cases, personally, this is not going to be the same thing for every person, but personally, I remove stops because I know that we're potentially chopping in a larger range right now. Okay, so volatility is not the same as directionality. Okay, so I got a volatile swing down. It doesn't mean I'm going to continue to move downwards. It could, but it could also mean that I'm chopping in a wider range right here. And so I remove that stop, but I'm going to keep that same target. What it means is that I'm going to hit that target way easier and way faster than before. I'm not going to suddenly blow out my target way higher because prices can move a lot more. And that's the equivalent, that's similar to what we were saying earlier about this. Okay, my allocation size is going to go down. I'm going to chase the same amount of money. I'm not going to chase a larger amount of money. I'm not going to move my target way up here. Okay, so that's how it would changes in the single call and put world. And then so let's see how that changes in my bull call spread. Or let's just say it doesn't matter if it was a debit or a credit spread, mathematically equivalent, right? So what is happening here is my curve flattened. Okay. So if prices move upwards, it doesn't help me as much, but it also doesn't hurt me as much. Why? Because we understand that prices are going to fluctuate up and down. Doesn't that sound basically like what I just said with the single? Right? I have to understand that we're going to fluctuate up and down. And so a downward move on paper hurts me because it moved down a lot, but it doesn't, in reality, it doesn't hurt me as much as if we were in a low volatility regime, because the possibility of it swinging right back upwards is even higher than it would have been before. Okay, so that this is kind of basically visually demonstrating the same thing. That flattening curve visually demonstrates that I need to be less sensitive to price changes. So if price goes way down, I need to be less sensitive to it. I can't freak out. I have to be like, oh, okay, this is normal. Before this downward movement was normal, and I wouldn't have closed the trade because I don't want to get stopped out by randomness or normalness. I want to be wrong. And a big move now doesn't demonstrate yet that I'm wrong. Okay. So over here, I'm going to, that volatility is built in. I don't have to make that evaluation or judgment myself because the entire spread, the pricing already takes that into account for me. Whereas the basic call or basic put is not going to do that for me. It's actually going to exaggerate the performance. It'll look like it's a bigger loss than what I would have suffered normally, or a bigger gain than what I would have gained normally. So the vertical spread structure automatically dampens it for me and makes it easier. So what it means though is I'm at risk. If I was in profit, I am now at risk of getting thrown out into the loss zone. And if I'm in a loss zone, I'm at risk, if you want to call it risk. We still call it risk in the business, but you might think of it as opportunity. I have a better opportunity now of swinging back into the profit zone, which is why I don't immediately cut my losses. It's the same thing over here. You don't immediately cut your losses because there's a probability, a higher probability that we're going to swing right back into the gain zone. So you can't use tight stops. So it doesn't matter if you're in the vertical or you're in a single. So basically, I become less reactive and less sensitive to those price movements. But if I have a profit and I'm close to the break even or the point of inflection where I would go into loss, then I'm going to take my profits sooner than before, because that volatility could just throw me down in there when I don't want it. I understand, yeah, if I go down there, I could come right back up fairly quickly. But if I don't want to suffer that daily volatility in my portfolio marks, then I would just sell these positions and say, okay, I'm going to go into positions that are more appropriate for this volatility regime because I put on this trade before that switch. And guess what? If I put on a new trade within this volatility regime, that's going to build in the increased volatility already. And so the levels that I'm getting, remember, I'm not changing how much money I want to make. I want to make the same thing. So if I over here, when volatility hadn't moved yet, and I can make a spread that would gain maximum gain of, call it 100%, okay? That is, or 100% is not a great example. Just say 50%. Okay, I want to be a little bit conservative and say I want a spread that can make me 50%. The strikes are going to be wildly different now than my strikes would have been immediately before that high volatility spike. And so I'll be able to basically take into account the new volatility regime with my new vertical. So I personally would, if I'm close, if I'm way up here, it doesn't matter, right? I don't care, right? Like I said before, you're insensitive. If you're so far in to your profit zone, you're insensitive to that volatility. It's only in this area, in this particular one, from the 620 to 680 area, where you would have sensitivity to it. Now, over here, 700 and up, you see like nothing changes, okay? So if I'm in that area where we would be sensitive to it, then I would just take my profits and open a new trade if I still wanted a trade on, appropriate for the regime. Yeah. Okay, so I hope that answered your question. What is the difference between a gamma pocket and open interest? Open interest just means that there's people who have bought those contracts. Okay? That's it. So if I go over here and I say, I will just use XSP. I've got open interest. There's 10 contracts here. Okay? That's all it means. There's 10 contracts that were traded at 621. Some person believed that that would be a nice strike to go into, and they bought that 621. Gamma exposure means that because of that open interest inside of that 621, the market maker has a certain amount of risk. And depending on how much risk they have, a $1 move in XSP could cause them to lose or make X amount of dollars, which they don't want. That's risk that they don't want, okay? So there's a big difference between open interest and gamma exposure. Now they're related. The more open interest you have, the more gamma exposure the market maker has. But that's about the extent of that relationship. So some people will be like, oh, well, look at that. There's 2,400 contracts right there. And you say, isn't that's going to be a large gamma pocket? And I would say, maybe, you don't know that that's a huge risk for the market maker, because look how far out of the money it is. What's the probability of us actually getting to 642 today? So that gamma exposure basically amounts to zero, because we were so far. We never came close to 642. We never even came close to 630 or 629 or 8. So the exposure here, the risk to the market maker here was almost zero, but you have a whole bunch, by far, maybe more than several strikes added up together of open interest. So you would have made an extremely erroneous conclusion if you went to open interest and said, hey, there's a huge amount of exposure right here. And I buy into all these conspiracy theories that market makers move markets. And I think the market maker is going to push XSP all the way up to 642. The answer is nuh-uh. They don't care about 642 at all, because they have almost zero risk there. I promise you they have far more risk over here on that 88 open interest at 625 than they did over here. Okay, and so can I prove it? Sure, why not? Let's go to gamma. Where did it show up? Okay, so that's roughly 2.9 million right there in gamma exposure. Where is my 642? Oops. Okay, what's 1.1 million? Far, far, far more, like almost triple the amount of risk at 625 versus at 642. But 2,400 contracts versus 88, okay? And it's still only a third of the risk to the market maker, okay? So that is the giant mistake that you'll make if you just look at open interest and think it's the same thing. It's not even close. Okay. All right. Helpful? Good. Thank you, Phil. What's the risk management techniques I apply to my trades? Depends on which regime I'm in. That is like, that's many lessons worth of risk management is probably the most important piece of your trade, right? You have the trade idea, the execution, the timing, the execution, and the risk management. So for most portfolios, risk management is going to be the most important. The shorter your portfolio time frame is, then I'm not going to say that it's less important, but the simpler your risk management becomes. Because for example, if I'm scalping, day trading scalping, then my risk management is most likely it wins or it loses. It makes full loss or it makes my expected gain. Right? And that's it. Why? Number one, I don't have time to go in there and consider all these things and manage all these different things. But also the life of the trade is so short that doing anything weird or complicated or adjustments or anything like that just doesn't make sense, practically or logically. So the longer term your portfolio is, the more complicated your risk management becomes. So that's why professional portfolio managers, they generally have a much longer time horizon than a retail trader. And so they will do things like hedging techniques and put on delta hedging, beta hedging, things like that. And then a retail trader tries to mimic the professional and say, I don't need to hedge my portfolio. And then they go, why am I not making any money? It's because you're applying the wrong risk management technique for your portfolio and the types of systems and types of trades that you're making. But also, there's you need to take it into that context of what regime that you're in. There's a lot of portfolios in existence that won't trade right now. VIX over 20, sorry, all systems turn off. So those are the really risk-averse ones, like insurance companies, for example, and pension funds. So they'll just stop trading. That's their risk management. No trades. Sit on your hands, cash. Very few retail traders are going to do that. Actually, I'd be surprised if more than 0.1% of all retail traders go, oh my God, VIX over a 1%, let's not do it. I'm going to sit it out. And you go, you're going to sit it out? You're going to sit it out for 3 days? Sure. You're going to sit it out for, what was this? Feb 24 to March 24. You're going to sit out for a whole month? You're going to show up every day and stare at a screen and do 0 trades for an entire month? You're going to do that? And then a few days later, you're going to sit it out again from March 31st all the way to May 12th. So for more than a quarter of the entire year, you're going to sit there and do nothing as a retail trader? I don't think so. I don't think so. All right, the pros can do it because of their positioning, their long-term positioning. 3 months is nothing to them. And they're also collecting management fees, so they're still making money. So I don't think a retail trader is doing the same thing. So it's got to be appropriate to the environment that you're in, the types of trades and the types of systems that you're trading, and it's got to make sense for your time frame. Okay, so I wish I could go deeper and more detail than that, but one, I'm not going to have time, and two, it's probably not. That's not what we're here to do. We're here to look at the post-market analysis and figure out, as we are doing education as well, but we would need like some very focused sessions and extended periods of time, so like multiple hours for us to really get into the proper risk management. Okay. So hopefully that's good enough for you for now. All right, so we are getting pretty close to our 1 hour. Are there any other questions that I can answer for you guys real fast? Basically, we are at a change of volatility regime. We need to start changing our investment behavior from the existing positions that we have, but also going into new positions. So because I don't know if this is going to go for a couple days or if it's going to go for an extended period like this, it's like I said, you either take a trade that can span both possibilities, or you wait a few days and see if we slip right back out of it. So next week on Monday, maybe we'll start looking at potential ways to trade, depending on what happens with the volatility too. Maybe we'll go right back in and then we won't learn how to trade in a new volatility regime. But if we stay there, then we'll start looking at ones where like I just said, where it doesn't matter if it slips right back out or it stays there for a little while. And then if we get a regime where it stays there for a little while, then we'll be looking at even different type of trades, because there'll be more lucrative opportunities for the ones that you just stayed in there for a while, then instead of having to hedge yourself and say, well, it might drop out pretty soon as well. Okay. All right, guys. I don't see any other questions. So have a wonderful rest of your day. Have a wonderful weekend, and I'll see you guys on Monday. Okay? Bye, everyone.